I've noticed a lot of traders are scared and shy away from trading the actual day of earnings. And that didn't ever make a lot of sense to me. If you're new to trading or you're a beginner trader, then sure, that makes a lot of sense, where you might be simply observing earnings. That's a lot of volatility to digest as a new trader. However, if you're experienced, you've been at this game for quite some time, then earnings provides a very unique opportunity. We get the volatility that we typically have to wait days or weeks for in a matter of a few hours inside names that are fairly large names backed by institutions. In today's video, we'll go through 4 different examples, and I'll show you what earnings volatility looked like and how to take advantage and profit from this volatility. If you're new to our channel, I'd also recommend checking out our website, tosindicators.com/earnings. I'll leave a link to this in the description box below. It has this free 1-hour long tutorial which walks through how to trade moves headed into earnings, the actual day of earnings, along with how to trade post earnings. So I'll leave that here as well. That gives some helpful additional information beyond just today's video as well. Now, for all 4 stocks we'll talk about in today's video, all 4 stocks were found using our Stock Volatility Box live scanner. This live scanner is a custom scanner that we've built inside of our Volatility Box platform. It surpasses really anything possible inside of the Thinkorswim scan tab. It scans every 2 seconds in more than 10,000 plus stocks looking for new volatility setups. What I mean by volatility setups, that's where price action is breaching our volatility models, telling us that, hey, there's an edge here. You have a volatility edge. You combine that with the earnings related volatility, and you really have a nice system in place here to find some of these real nice setups very easily where the machine does a lot of work for you. The way I like to always describe the live scanner for those who are unfamiliar with it, think of it as having your own personal trading assistant that's working for you, scanning every 2 seconds, looking for new trade setups that fit this volatility model perspective framework that we have built up. Not only does it find these opportunities, it reports them on a running basis without any downtime. It doesn't need breaks. It doesn't need coffee breaks, anything of that sort. It simply just works. And that's the purpose of the live scanner. Now, the 4 stocks we'll talk about in today's video, Caterpillar, AOS, which is the chart I have loaded on. Both of those appeared on the overlap tab, which a good way to think about that is the best of the best. It looks for places where we have price in whichever stocks breaching hourly volatility models along with our daily volatility models. So it's the best of both worlds. If you're unfamiliar with what the hourly versus daily models are, I'll leave links in the description box as well, which break that down in a little bit more detail. Now, the other 2 stocks, I said 4 in total, so 2 are from the overlap tab. The other 2 are from the daily tab. One of them is Aflac. Aflac, I want to show you because it's an example of a stop. It's one in which the earnings volatility was a little too much. We didn't see sellers come in the way we expected, and quite honestly, that's okay. You'll see why some of these earnings trades really have some nice risks or rewards, which I think make it worthy of making it to any trader's trading setup arsenal. There's good strategies here with a lot of volatility you can take advantage of if you know what you're looking for. So Aflac, an example of a stop, which I think it's worthy of talking about. And then another example we'll also discuss is Merck, which reported earnings today. And let me show you Merck. And that triggered on our live scanner 2 different times. The first was when it hit our aggressive volatility box models, and the second is when it hit the conservative models. So a lot of different setups today. Let's dive in. My goal is you get something out of today's video and you have a much better understanding of how to take advantage of earnings volatility instead of being scared and shying away from it. Now, the first setup we said was AOS. AOS reported earnings today before the market opened. You can see earnings was a beat. So if you had any kind of bias, that bias might be bullish just based off of the EPS beat here. Now, starting off the morning, AOS opens, we have this little move up, and then we have a sell-off inside of AOS. We break through the aggressive models, we then come to the conservative models, and we technically break slightly outside of them as well with this wick right here. Now, it's not really the wicks or these levels that we're looking at, it's price that we're looking to understand. So here, if I zoom in, we can see AOS breaks down and comes all the way down to the conservative volatility box models. Already there, that's your clue that, hey, we're at the conservative model here on an earnings beat. We're really looking for price to start to reverse here, at least show signs of reversing. Then we start to see these Keltner channel wedges, 1, 2, 3, and 4. That tells us that, hey, price is now outside of the 3.0 Keltner channel, which means we're extended on that perspective as well. Then we get the edge signal confirmation. That's this green arrow, which is our overbought, oversold confirmation. In this case, oversold, telling us that, okay, now we're expecting buyers to step in. After that, we see this blue dot, which is the momentum cross, and that's simply the 3 EMA and the 8 EMA. And this tells you that, hey, the 3 has now crossed above the 8. That shorter term trend, that shorter term momentum is starting to switch to the upside. Now, if I zoom out and you take a look at what happened inside of AOS, this is the kind of earnings volatility we're looking to take advantage of, right? If you take a look at what that risk was, about 58 cents. If you take a look at the max move that we can actually get out of this, about $2, $1.83, a 2.74% move in which you had a lot of probabilities skewed in your favor. You had an earnings beat, you had volatility models telling you were extended, you had price action telling you you're extended along with technical indicators, you had overbought, oversold signals, everything coming together to give you some nice opportunities and take advantage of the earnings volatility instead of being scared of it. Now, another example we can take a look at. Caterpillar, another large name, institutional backing, ones in which you would expect buyers to step in at these levels. If we take a look at what happened to Caterpillar, again, reports earnings before the market opened, an earnings beat, so your bias is a little bit more towards the bullish side if you do have a bias at all. We come right out the gate running, we have a sell-off. Right out of the gate, that very first minute is where we hit our aggressive volatility box models with this wick. And very quickly, you can see how institutions are quick to buy this level. Here, we don't see the same Keltner channel wedges down here. Instead, we just have that morning candle. It's hiding behind this price candle here. But hopefully, you can see that outline of the wedge here, which tells you extended on the Keltner channel. Here, we had 4. We came back in, then we came back out. So extended. We have the oversold confirmation with the green arrow. We then have the momentum cross. And if I zoom out, take a look to see what happens inside a Caterpillar. Not only do we rally, but we rally all the way to the other side's volatility box zones, where now we'd be looking for a short if this wasn't so late in the day. So Caterpillar, another example of a company which reported earnings before the market opened, was an earnings beat. We had a sell-off. We had concrete levels ready to go where we were happy buyers, happy to take advantage of this discount. And you can see how that discounted pricing leads to some nice opportunities, again, with the risk to reward skewed in your favor. Now, speaking of risk to reward, I think this might be a good segue for Aflac. Aflac here also reported earnings, also had an earnings beat, but here, even though we had an earnings beat, we were still looking to get short Aflac as it had hit our conservative volatility box zones. So here we had price action tell us we're extended, same setup inverted, the overbought signal in this case, the momentum cross to the downside, but simply Aflac here just does not reverse. Instead, we see price action continue rallying. So here you might be thinking, okay, well, this is a stop out. The strategy doesn't work. First of all, no strategy works all the time. Important to keep that in mind. But second off, risk to reward is what we care about here. Even if you use the momentum cross as your entry, your risk here was about 70 cents, but in terms of the reward, we were looking at closer to about $1.53 if we saw the same sort of reversal as we had inside of Caterpillar, as we had inside of AOS. If you got an entry towards the clouds, which is where we prefer our entries, there your risk gets cut even more, which makes the strategy worthwhile. It allows you to manage your risk reward in a way that allows you to have some real nice winners when they go in your favor. And when they don't work, you're allowed to cut it short without really having too much damage that's already been done. So Aflac, a good example of a stop out in which the trade did not work. There's a few different things we could have learned from it, sure, like say trying to fade after an earnings beat. And this is a relatively strong earnings beat at that, 155 compared to 138. So there might be some lessons there. But even if you disregarded that, looked at pure technicals here, you still were able to manage your risk to reward in a way that makes sense. Now, the last setup is Merck. Now, Merck, very similar example here as well. We had earnings which was a beat, 140 compared to the estimate of 134, so slight bias towards the bullish side. We had the Keltner channel wedges plotting early on in the morning. We had the oversold signal. We had the momentum cross. We even made a small move hitting T1 before price action reversed here, going outside of the clouds before that second confirmation here, which is the one that really took off running. So that first one was a fake out. Still hit that T1 level that we have, this gray first target line. Remaining stops are moved to break even, which got taken out here. That re-entry is a skill that I think a lot of us can get better at. But for another data point here, Merck, great example of another stock where, one more time, risk to reward, very much skewed in your favor. About a 53% risk for what was a max reward of about $4. Of course, not sure you would have gotten the full move there, but in terms of our levels that we were targeting, you had the target lines across the board along with the opposites target lines for the short side levels, looking for places to try and take some profits along the way. So hopefully through today's video, you saw 4 different examples of stocks. We went through AOS, real nice example there. We went through Aflac, an example of a stop. We went through Caterpillar, example of a fairly large cap name. And then we went through Merck, another example of a large cap name, all of which to give you an idea of how earnings volatility can be a blessing in disguise if you know how to trade it. There's no reason to really shy away from it. If you're new to trading, observe it. Observe a few earnings cycles, get that experience under your belt. But this earnings volatility does present very unique opportunities where you get moves that we typically have to wait, again, days, if not weeks for. You get those in a period of just a few hours, which here, a few different examples helps demonstrate just that. Take care, everyone. Good luck trading, and I'll see you in the next update.